profitable, and broke? The day payroll failed, the company was profitable. Revenue was growing. Clients were paying. The books looked healthy. And then one Friday morning, payroll failed. That was the day cash flow ran out. This is the story of a business that did everything right on paper and almost collapsed because profit is not the same thing as liquidity. Sophia launched her logistics company 5 years earlier with a clear niche: specialized delivery for mid-sized manufacturers. It wasn't glamorous, but it was dependable. She built relationships carefully, negotiated contracts wisely, and scaled gradually. Within 3 years, the company crossed 7 figures in annual revenue. Margins were solid. Accountants praised the income statements. Investors began showing interest. Sophia felt confident. The company was profitable. That meant it was safe, or so she believed. As contracts grew larger, payment terms stretched. 30 days became 60. 60 became 90. Some enterprise clients insisted on even longer cycles. Sophia agreed because the contracts were substantial. The revenue numbers justified the patience. Meanwhile, expenses operated on a different clock. Fuel suppliers required weekly payments. Drivers expected biweekly salaries. Equipment leases were fixed monthly. Insurance premiums were automatic withdrawals. The business was profitable, but cash moved unevenly. Here's the subtle danger most entrepreneurs underestimate. Revenue is a promise. Cash is reality. For a while, the timing mismatch didn't hurt. There was enough reserve to cover temporary gaps. Sophia reinvested profits into expanding the fleet, hiring additional staff, and upgrading software systems. Growth required capital, and the income statements supported the expansion. Then a large client delayed payment unexpectedly. Not permanently, just delayed. 90 days became 120. At the same time, fuel prices rose sharply. Operational costs increased overnight. Payroll expanded because of recent hires. The bank account began shrinking faster than anticipated. Sophia reviewed the financial dashboard and felt confused. On paper, the company had record revenue. Contracts were signed. Invoices were issued. The profit projection for the quarter was strong. But the bank balance told a different story. Cash flow is about timing. And timing doesn't appear clearly in profit summaries. She reassured herself it was temporary. Payments would arrive soon. But weeks passed. More invoices accumulated. Receivables grew. Actual cash did not. Then came the Friday that changed everything. Payroll processing returned an error. Insufficient funds. Sophia stared at the screen in disbelief. How could a profitable company fail to pay employees? Because profitability measures value created. Cash flow measures survival. In that moment, theory became personal. She immediately contacted the bank for a short-term credit extension. Approval required documentation and processing time. She contacted the delayed client, who promised payment soon. She considered delaying supplier payments, but that risked damaging relationships built over years. The stress was immediate and intense. Employees relied on their salaries. Drivers had families. Trust was at stake. Sophia managed to secure emergency financing just in time to cover payroll. But the scare exposed a structural vulnerability she had ignored. Growth had outpaced liquidity management. Over the next few days, she performed a deep financial analysis, not of revenue but of cash conversion cycles. She mapped every inflow and outflow. She calculated average days receivable versus days payable. The imbalance was clear. The company financed client operations for months while covering its own expenses weekly. The business wasn't weak. It was misaligned. Many founders celebrate large contracts without analyzing payment structures. They focus on total value instead of timing risk. $1 million contract paid over 120 days can create more stress than a smaller contract paid within 30. Sophia realized she had optimized for revenue growth instead of cash stability. The turning point came when she made 3 critical decisions. First, she renegotiated payment terms for new contracts. Shorter cycles, partial upfront deposits, or milestone payments became mandatory. Some prospects resisted. A few deals were lost. but liquidity improved immediately. Second, she implemented stricter receivables management. Invoices were followed up proactively, not passively. Automated reminders replaced casual emails. Payment delays were addressed early, not tolerated quietly. Third, she built a cash reserve policy. A portion of every payment was allocated to a protected liquidity account designed to cover at least 3 months of operating expenses. That reserve was untouchable except for emergencies. These decisions slowed visible growth temporarily, but they strengthened the foundation. There's a common illusion in business that profitability guarantees security. It doesn't. Profitability measures performance over a period. Cash flow determines whether you can operate tomorrow. A company can be profitable and still collapse if it cannot meet short-term obligations. Sophia learned this lesson before it became irreversible. Some businesses don't. Think about the pattern. Rapid expansion increases receivables. Larger contracts extend payment terms. Fixed costs rise with hiring and equipment. If incoming cash is delayed while outgoing cash remains immediate, the gap widens quietly until it becomes critical. And because profit reports often look positive, leaders feel safe. But survival is not measured by margin percentage. It is measured by liquidity. Months after the crisis, Sophia's company looked different. Revenue growth was steadier rather than explosive. Contracts were structured with cash flow in mind. Financial dashboards prioritized liquidity ratios alongside profit metrics. Most importantly, she no longer equated revenue with security. The experience changed her leadership philosophy. She began asking a different question in meetings. Not, how much will this deal add to revenue? But, how will this deal impact cash timing? That subtle shift altered decision-making across the organization. There's a broader lesson here beyond logistics or entrepreneurship. In personal finance, high income does not protect against poor cash management. In investing, unrealized gains do not pay immediate obligations. In corporate finance, projected profits do not guarantee payroll coverage. Liquidity is oxygen. You rarely notice it when it's abundant. You panic when it's scarce. The day payroll nearly failed became a defining memory for Sophia, not because the company collapsed, but because it almost did despite appearing successful. The experience forced discipline. It forced humility. It forced structural awareness. And it revealed something powerful. Growth without liquidity planning is fragile. If you are building something right now, examine your cash cycle honestly. How long does it take for revenue to convert into actual money in your account? How long can you sustain fixed expenses without incoming payments? Are you expanding faster than your liquidity can support? These questions are not pessimistic. They are protective. Because the most dangerous financial surprise isn't a loss. It's realizing you're profitable and still can't pay your bills. Sophia's company eventually grew stronger than before. Not because revenue doubled, but because resilience did. Liquidity buffers expanded. Payment terms stabilized. Stress decreased. The day cash flow ran out became the day financial discipline matured. And that's the hidden truth most balance sheets won't show you. Profitability builds value. Cash flow sustains existence. If this story made you rethink how you measure success in your own business or career, then it has served its purpose. Sustainable success requires more than strong numbers. It requires strong timing. If you found value in this episode of Wealth Narrative, make sure to like the video and subscribe to the channel. We explore the financial realities that shape long-term survival, and sometimes the most important lessons are the ones hidden behind impressive reports.